G'day and welcome to the Morgans Edward Street weekly wrap for the 8th of June. Winter has set in here in Queensland with a 12-degree low expected today. The volatility index has also plummeted down 20% since the start of winter, which is starting to see some positive results for the ASX 200. I'll pass you over to Matt for more.
Yeah, thanks Cam. US markets have been creeping higher this week as the negative news flow starts to subside. As a result, our market, as Cameron said, has found its way back above 6,050 points, supported by commodity strength and in particular copper, which has reached recent highs of $3.30 a pound overnight. Our market still has to climb the wall of worry to push higher, as there are still plenty of headwinds, including rising bond yields, Trump trade wars and Italian elections on the table. Nevertheless, our market continues to grind higher over time, still searching for the all-time high of 68.50 from over 10 years ago, and in the shorter term 61.50, which is still a key level to watch, which was set both in January and May this year. Before Cameron talks to you about his stock idea of the week, I thought I'd update you on both BHP and Telstra, which I'm sure all of you know quite well. Adrian Wood, who is Head of Investor Relations for BHP, presented to our network earlier in the week. One of the key takeaways from Adrian was BHP's capital discipline is holding together, and there looks to have been a cultural shift on this front. That is, BHP has seemingly learned lessons from the past peak cycle acquisitions, such as the $15 billion acquisition of Petrohawk Energy in 2011 and the $4.75 billion purchase of shale play Chesapeake Energy that destroyed company value. BHP trades above 34 and is a core holding for most clients. Lots of positive news being baked into the share price at present, including the sale of US oil shale and potential special dividends. But BHP is always a tough one to part ways with. But keep in mind, it was $14 2 years ago and cyclical in nature. So perhaps at 36 being 2014 highs, it might be worth trimming a few. Over to Telstra, and Morgan's analyst Nick Harris provided some feedback from his visit to Telstra 5G Innovation Centre at Southport last week. Nick highlighted some interesting points, and that is that 5G is still about 5 years away in Australia, spectrum to adopt yet to be chosen, with a global meeting around standards and specifications set for September this year, and with a government spectrum auction later in November, December. For context, it took 13 years to roll out 3G in Australia, while 4G took 7 years. 5G is likely to roll out even quicker, particularly given the commercial imperative for telcos to move more quickly and bypass the NBN. The next key catalyst for Telstra is their Investor Day on 20 June. Nick maintains his ad recommendation of $3.99 price target. Nick's positive view is largely predicated on the view that NBN will not survive under its current terms and that competition is at its peak. This also underpins Nick's view that Telstra will maintain its 22-cent per annum dividend, and he believes the one-off disconnection payments from the government help underwrite the dividend in any case for the next few years. Telstra trades around $2.80 and looks relatively cheap at current prices. Thanks.
Thanks, Matt. I'm going to talk about another large cap company in Ramsay Healthcare, ticker code RHC. Ramsay is engaged in the provision of healthcare services and the operation of hospital and day surgery facilities across Australia, France, the UK, Indonesia and Malaysia. This is an investment on the ageing population thematic in a sector which is difficult to find value in. Ramsay is currently priced at its lowest level in 2 years, and this is 20% below the 4-year average PE. The overseas headwinds continue to remain the main concern, with their result in February disappointing the market, and will be the focus for investors on any update. France represents 37% of their exposure, with 9% in the UK and the remainder in the Asia Pacific region. On the numbers, Ramsay looks appealing, with a forecasted growth of around 8 to 10% over the next 2 years. Whilst it's not stunning growth, Ramsay trades on 18 times FY19, which is cheap for the overall healthcare sector, which is currently trading on 28 times. The other appealing factor was the recent bid for Healthscope at a significantly high premium, which bodes well for the sector. Our analyst has a hold recommendation with a $69 price target. Based on the recent weakness, I'll be watching for a potential upgrade as a sell-off seems overdone. Cheers, mate.
Well, that's it for this week on the Morgan's Edward Street Weekly Wrap. Enjoy your weekend, and we'll see you again next week. Thank you.